Today is one for the history books for Palantir. Palantir just hit a new all-time high. The community is celebrating. The atmosphere has turned bullish. Analysts are dropping their signals. Palantir just overtook some tech giants today. However, one analyst pointed out something odd, and this might just hurt Palantir. What is happening? And what on earth am I even talking about? Well, let me explain. Disclaimer. Palantir fans are celebrating again because the stock just blasted to a jaw-dropping $116 per share, a brand new all-time high. The excitement is unreal. Every day, it just keeps climbing, making skeptics look silly for calling it overvalued or overpriced. Sure, they've been saying that for a while, but guess what? Palantir doesn't care. It just keeps proving them wrong. And analysts? Some are calling it priced to perfection, meaning it's already trading at the best-case scenario valuation. One analyst put it perfectly in a tweet, saying Palantir is now the 38th most valuable company on the planet, and already up 54% this year. But here's where things get interesting. He pointed out that most retail investors, the smaller everyday traders, are selling rather than buying. So who's fueling this insane rally? According to him, it's either a fresh wave of new retail investors or the big institutional players piling in. If it's the big money, that's a game changer, because those guys don't just jump in for quick trades. They bet on the long haul. If they believe in Palantir's future, it could mean even more upside ahead. But hey, maybe he's wrong. Maybe this is just another wild market moment. Either way, one thing's for sure. Palantir is the stock everyone's watching right now. Now here's the crazy part. Palantir just pulled off something unbelievable. With this insane rally, it actually traded more volume than Apple and Microsoft combined. Let that sink in. One analyst pointed out that Palantir saw $7.3 billion worth of shares traded in a single day, while Apple and Microsoft together had $7.2 billion. That's not just some random number, it's a huge deal. Apple and Microsoft aren't just any companies. They're absolute giants, worth trillions, dominating the tech world for decades. Their stocks trade millions of shares every single day because they're the go-to investments for big institutions, hedge funds, and everyday investors. They're basically the backbone of the stock market. For Palantir, a company that just a few years ago wasn't even on most people's radar, to suddenly outpace them in trading volume, that's not normal. It shows just how much hype, excitement, and momentum is behind it right now. People aren't just watching Palantir, they're actively buying, selling, and making massive moves around it. See, Apple and Microsoft stocks are steady, reliable, and rarely experience these crazy spikes in volume. They're like the ocean. Constant waves, but nothing too wild. Palantir, on the other hand, is like a storm that just came out of nowhere, shaking up the market in a way that very few stocks ever do. When a stock's trading volume explodes like this, it usually means something big is happening behind the scenes. It's a sign that big money is involved, and people are betting on something much larger playing out. Whether it's institutional investors piling in or a massive shift in sentiment, one thing's for sure, Palantir isn't just another stock right now. It's the center of attention. But it doesn't stop there. Palantir just did it again. It's not just breaking records in trading volume. Now it's officially bigger than Wells Fargo in market cap. Yeah, a 170-year-old banking giant, completely overtaken by Palantir. One analyst pointed it out, and it's honestly wild to think about. Wells Fargo has been one of the biggest names in finance for generations. It has branches everywhere, millions of customers, and a history that goes back to the gold rush era. Meanwhile, Palantir? A relatively young tech company that, until recently, wasn't even considered a major player by Wall Street. And now, it's worth more. This isn't just some random milestone, it's a huge shift in how the market values companies. A traditional banking powerhouse built on lending and financial services just got passed by a data-driven AI company that thrives on software and intelligence. It shows just how much the world is changing. Investors aren't just looking at old-school financial institutions anymore. They're betting on the future. And right now, that future looks a lot like Palantir. At this point, it's hard to say what's next, but one thing's clear. Palantir isn't slowing down. However, despite all the bullish hype, one analyst on Twitter dropped a bombshell that got everyone's attention. And it has to do with something pretty unexpected. How Palantir actually makes its money. Let's just say, it's a little odd. He pointed out something massive. About 40% of Palantir's operating income isn't even coming from its core business. Instead, it's coming from interest on its cash. Yeah, that's right. Not software, not government contracts. Just money sitting in the bank, collecting interest. And here's where it gets even crazier. If you strip out that interest income and look purely at how much profit the actual business is making, Palantir is trading at over 800 times earnings. That's an insane valuation. Most companies trade at 15, 20, maybe 50 times earnings if they're high growth. But 800? That's next level expensive. This kind of thing raises big questions. Is Palantir's stock surge really about its business growth, or is it just benefiting from high interest rates? And what happens when those rates go down? If a huge chunk of its income is coming from something that has nothing to do with its core operations, it could mean the market is way overestimating how profitable Palantir actually is. But wait, here's the thing. Even without that extra cash from interest, Palantir seems just fine. Another analyst pointed out something pretty interesting. Palantir is ahead, while spending less. And that's huge. He explained that this is actually a sign of strength. If a company can grow, innovate, and stay competitive without dumping insane amounts of money into research and development, that means it's efficient. It knows how to get results without burning through cash. A lot of people think that the more a company spends on R&D, the better it is at innovating. But that's not always true. It's not about how much you spend, it's about who's doing the work. He used a perfect example. Imagine you had $10 million to spend on research. Would you rather hire 10 top-tier software engineers or 1,000 random workers with no real expertise? The money spent is the same, but that small elite team will almost always produce better, more valuable discoveries than 1,000 people just throwing things at the wall. That's what's happening with Palantir. It's not just about spending more, it's about spending smart. Other companies might be pouring billions into R&D, hiring huge teams, but Palantir is proving that having the right people matters more than having the most people. So, while some critics are questioning its income sources, this kind of efficiency is a major reason why investors are still confident. And here's the best part, Palantir's innovation isn't just hype. It's actually solving real-world problems, and today, we got a perfect example of that. Palantir's collaboration with Hyundai HD just had a major moment, with its AI-powered route optimization system going live for the first time ever. This isn't just some small tech upgrade, it's a game-changer for the shipping industry. Here's what's happening. HD Hyundai Marine Solution, a marine tech provider under HD Hyundai, has officially deployed Palantir's AI system on South Korean commercial vessels. The goal? To cut down fuel consumption and slash emissions. And in a world where fuel costs are skyrocketing and environmental concerns are bigger than ever, that's a huge deal. Think about it. These aren't just minor tweaks. AI-driven route optimization means ships can navigate smarter, avoid unnecessary fuel burn, and operate way more efficiently. Less fuel, fewer emissions, and big cost savings? That's exactly the kind of real-world impact that makes Palantir stand out. So while people debate the stock's valuation, this is what's actually happening on the ground. Palantir's tech is out there, making a difference. And now, let's get back to what we've discussed in the last video. With Elon Musk's influence on Doge, Palantir might have a once-in-a-lifetime opportunity ahead. One analyst broke it down perfectly, and if he's right, this could be massive. So why Doge? And why Palantir? First, Palantir has a history of digging up uncomfortable truths. Back in 2024, co-founder JT Lonsdale hinted that Palantir had already uncovered billions of dollars in fraud and waste in Medicare and Medicaid, but the government at the time shut it down. So clearly, Palantir has the tools to expose inefficiencies on a massive scale. Now, here's where things get wild. Palantir's government business is still tiny compared to its potential. So where does Doge fit in? The theory is that Palantir could help identify waste and maximize efficiency across departments, unlocking billions in savings. No official confirmation yet, but there are some pretty big hints. Leaks about young engineers from the Elon Musk network, a mysterious Palantir CTO tweet, and even recent Musk comments that seem to nod toward Palantir. The big question now, will Palantir actually help Doge save billions? Or maybe even more? If it does, this could be one of the biggest plays in the company's history. But what is your opinion on this? Comment down below. If you are curious to find more, then make sure to click on one of the videos you see on the screen. And with that, we come to the end of this video. If you enjoyed the video, then turn on the notifications bell on this channel. Missing an important Palantir update might make you lose money, so don't risk it. Also, please share this video with as many people as possible. Let's get this news out there.
Things just got out of control. The entire crypto market is booming. But when it comes to Shiba Inu, it faces a different story. While the price chart is green, this is not what was supposed to happen. Over 50 trillion Shiba Inu is now in danger. And the impact we might see in this couple of days might be insane. Something that we have never ever seen in our entire history. But what's actually going on? And should we panic? Well, let me explain. Disclaimer. The crypto market is going absolutely crazy today. Prices of almost all cryptocurrencies are skyrocketing, and it's all thanks to Ethereum. Ethereum alone has surged nearly 20% in less than 24 hours. This is especially wild because Ethereum has a massive market cap, making such huge percentage gains extremely rare. To put this into perspective, the bigger the market cap, the harder it is for the price to move significantly. Think of it like this. A small boat can be tossed around by the waves easily, but a massive cruise ship remains steady. Smaller cryptocurrencies, like a small boat, can experience massive volatility because it takes less capital to move their prices. Conversely, larger cryptocurrencies like Ethereum are like the cruise ship. It takes a huge amount of money to cause significant price changes. This makes Ethereum's 20% rise in such a short time almost unprecedented. And here's something interesting. This incredible surge in Ethereum is also dragging other cryptocurrencies up with it. The rising tide of Ethereum's success is lifting all boats in the crypto market. Notably, Shiba Inu, which is built on the Ethereum blockchain, is experiencing a significant impact as well due to its close connection with Ethereum. The ripple effect is massive, creating a wave of positivity across the entire market. But what is happening? How long will it last? And what's with our beloved Shiba Inu coin? Well, let's find out. It all comes down to a buzz around a crypto ETF, similar to what we saw in January with Bitcoin before the Bitcoin ETF was approved. After Bitcoin's ETF got the green light, companies quickly shifted their focus to Ethereum, aiming to secure an ETF for it as well. Almost half a year has passed with very little news or updates on the Ethereum ETF front until today. Something remarkable happened. Eric Balchunas, a well-known Bloomberg analyst specializing in crypto ETFs, updated his forecast. He boosted the likelihood of a spot Ethereum ETF approval from 25% to 75%. Balchunas, who has been pivotal in covering the spot Bitcoin ETFs launched in January 2024, shared his updated insights on X. This instantly sent shockwaves through the crypto markets, causing Ethereum's price to surge over 10% within minutes. Of his post, Balchunas mentioned hearing chatter this afternoon that the SAC could be doing a 180 on spot Ethereum ETF applications. Up until now, the SEAC has been mostly silent on Ethereum ETFs, caught in a debate over whether to classify Ethereum as a security or a commodity. This silence was previously seen as a bad sign for ETF approval chances. However, with a crucial deadline approaching for multiple ETF decisions on May 23 and 24, the pressure on the SEC is mounting. The SEC already knows how intense and vocal the crypto community can be, especially from their experience with the Bitcoin ETF pre-approval period. Back then, the community was incredibly pushy and even angry towards the SEC demanding clarity and action. Now with Ethereum, the pressure is even more palpable. The SAC is fully aware that delaying or denying these ETF applications could trigger a significant backlash from an already impatient and eager crypto community. And just because of this heightened excitement in the crypto market today, Shiba Inu has also surged by over 6%. But here's where it gets really interesting. As Shiba Inu climbed, it hit a crucial price level that has everyone on high alert. A staggering 58 trillion Shiba Inu is now at the heart of an intense tug-of-war battle between bullish and bearish forces. To put that in perspective, this represents over 10% of the entire Shiba Inu supply. According to data from IntoBlock, a staggering 58 trillion Shiba Inu were acquired by 57,000 addresses within Shiba Inu's current trading range. This threshold has now emerged as a battleground where the short-term fate of Shiba Inu's value hangs in the balance. Bulls, the optimistic traders betting on price increases, are rallying to defend this level. They hope to ignite a surge in Shiba Inu's price even more. On the flip side, bears, the market pessimists, are pushing back, aiming to drive the price down and capitalize on potential declines.